So I think it's the snapping of the stock market is the key issue right now, and ambushing people's emotions and generating some fear that will move more money into already what's going on in gold and silver to the upside.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 14th through October 21st, 2024, while supplies last. First, we have pre-33 $10 Liberty Gold Eagles in XF condition, just $24.99 over half of spot per coin. Next, backdated 1-ounce silver Australian Kangaroos are just $2.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Thanks for having me on, Elijah. Thank you.
Well, it's great to have you, especially as we see gold touching again the $2,700 level. And also, you've mentioned how silver, there was really a bear trap. So essentially, a lot of people were thinking that it could fall lower, but here it is back around the $21, $22 level. Your take on what is happening in both gold and silver?
You mean 32? Yeah, right. Silver continues to act like that little wild dog on a leash. Sometimes it outperforms gold, and there's other times where it's, you think, oh gosh, it's never going up. Okay. But watch the mama market. As long as gold is steady, firm, ongoing, silver will follow it. Okay. There's no issue about that. You're not going to have an up in gold and down in silver. The short-term swings you see day to day, or maybe even hour to hour, they're to be ignored if they're down. And then they outpace gold sometimes. So I think we're at the edge right now in this advance in the monetary metals, where if you engage any more, you're going to really start to see more speed in both markets. And at that point, I think you'll see silver rush to the front again. The dog on the leash pulling mama this time instead of being pulled. And I think right now the thing to watch and what we do at MSA is we look at all four major asset categories. Foreign exchange has been dull for a year and a half. It hasn't played a role really in moving markets. Okay, dollar, euro, that kind of stuff. It's been horizontal. The bond market recently, starting in July, shifted up enough in price, drop in yield, to break through some metrics for us that indicate probably over the next quarter or two, it's going higher. Yields will go lower. Now, in the last 4 weeks, you've seen the opposite. You've seen T-bonds pull back, while what? The S&P has gone up. Okay? The Fed cut rates, the S&P's rallied for 4 weeks. This is exactly what happened, by the way, in 2007 at the top. Fed cut rates, market went up for 4 weeks and topped. Okay. The bonds have become inverse to the stock market. Despite the seeming illogic of that. In other words, if rates go down, that should be bullish for the stock market, right? The long end. But that was the case between 2000 and 2002. When the stock market went down, rates went down. Bond market price went up. Gold went up. 2007 to 2009, stock market went down big. Bonds went up and gold went up, except for one brief month in that period for gold. It was a down. So both gold and T-bonds have been firming relative to the stock market, but they've not really unleashed on the upside in a way that's, headline generating. And I think the reason for that is that the stock market, while it's dancing around up here, every other day, Dow or S&P makes new all-time high. You hear it on Fox Business or CNBC. And each time it does it, it's like a marginal new high by 5 more S&P points. And then you pull back for a couple of days and then go up and make another new high. And it's constant headline, new highs. Meanwhile, the NASDAQ 100 so far has not made new highs. It made its high in July, I think it was, and you're still below it. Now, maybe it'll make a new high, but it's toiling around. And the thing I think that's important here is the stock market's dynamics. While price looks super good, it just keeps sort of going up. But when you run long-term momentum studies of it, like we do, and look for structure, meaning something that it could break that indicates it's shifting to the downside. We're dancing on glass on these momentum structures. In other words, we're not breaking them yet, but we don't seem to get up and away from them. Like, it's weak. Momentum suggests it's weaker than you think it is. And I've gone back through history and, I've lived through a lot of this stuff too, but there's almost no time in the history of the stock market where there's been a sudden, dramatic drop, not necessarily a crash, but a dramatic drop that was warned by price. It's always warned by the momentum of the market breaking something if you know how to measure the momentum, structurally speaking. And right now we have, I would say, maximum pending negative structures below the stock market, S&P and NASDAQ 100, that suggests that if you sneeze, drop 1% or 2%, you're going to drop 5 or 10, and then you're not going to stop. In other words, there's so many dominoes, so many triggers that are clustered right below the market, and they adjust up under the market. As the market rises each month, let's say a little bit, those numbers come up. So the market's not really escaping stepping on the minefield, because the minefield is just, if you follow that logic. Okay. So I think the key to create market drama for the bond market to the upside, drop in yields, again, only for a quarter or two. I'm not looking for something long-term. And gold and silver to really launch is to engage the stock market to the downside, because we know what's going to happen then. First off, you'll ambush people psychologically. Nobody expects it to go down now. Even the bears, they've given up. When you shock them, then asset flows will occur. Large portfolio managers will move more money into Newmont, which they're doing aggressively, by the way, if you look at its chart. Back in February, when it was bought by a major fund manager who announced he was getting out of some tech stocks and buying Newmont, it was at $32. Right now it's $57, 6.5, 7 months later. Nobody's noticing it. But there is an asset class flow that's moving into the miners. Right now, the miners are at the high of their rally of so far the last 6, 7 months, and they're pushing at the highs of the last few years. So I think it's the snapping of the stock market is the key issue right now, and ambushing people's emotions and generating some fear that will move more money into already what's going on in gold and silver to the upside, and inject fear money into the bond market. So that's the key market to watch right now, I think, is the S&P and the NASDAQ 100. And we provide numbers to our subscribers every week. And we update the numbers because they adjust. Anyway, that's what you should be looking at right now.
And what kind of time frame are you going to be looking for it to maybe turn towards the downside?
I think you could any time. The daily situation was when you microanalyze the S&P day to day, for example, which is real short term. It's extreme. You can't sneeze. You can't drop 0.5% or 1%. You'll start breaking stuff. And then when you go to a little larger time scale, like weekly momentum, it's right under where the daily triggers are. They're all clustered very tight, which is not always the case. In other words, it's not always the case if you break the daily situation that you're going to damage the market. But we've got weekly, monthly, and quarterly momentum trigger structures that are all very tight below the market. And if you engage those quarterly numbers, and that doesn't take but about 2-3% in the S&P, it could get nasty, and nasty in a sudden way. And again, we still think, I've been saying for about a year now, and the University of Virginia Department of Politics had a poll a year ago in October that said they polled likely Trump supporters. What if the other side won? Would you resort to violence? The number was incredible. It wasn't like 30%, but it was like, I forget the exact numbers, but it was 15 to 20%. If the other side wins, is that the end of democracy? The number was very, both sides. Et cetera, et cetera. In other words, the temper and tone, and this was a year ago, and we know it's gotten worse since. So my statement, and it's hard to define it, except when I look at the technicals, I can see the triggers. There's no outcome to this election that will be copacetic and normal. There's going to be some things that happen after that election, regardless, again, who wins, that will be upending and cause people to have to suddenly reassess what's the nature of reality, which it's not going to be normal. And I don't think that is priced in at all in the U.S. stock. And we're very close to that event. So,
And why isn't that priced in? I mean, we're only, less than 3 weeks away here.
I don't think people quite appreciate. One side does. They say, oh, if Trump loses, we know there's going to be violence. Okay, that's the allegation. Okay, well, let's assume that's true. But what if she wins? I mean, what if he wins? Okay. And when I turn on MSNBC or CNN, I've heard nothing. You go back 3 or 4 weeks and you hear, at least on CNN, a fairly balanced view of, Trump's doing this and she's doing that, and this is their conference and this is, et cetera. All of a sudden now it's highly negative of Trump and using terms like, totalitarian, he's a fascist, he's going to use violence against his opposition. That has suddenly become the talking point starting about 3 days ago, I noticed. And it also shows up on public TV. It's like somebody pushed a button. So if he wins, and I think there's now a fear out there that he's going to. I think Obama even sort of subtly expressed it the other day. At least I'm hearing that, at the funeral of Kennedy's mother. We're going to lose this, that type of thing. And there's a sense out there among some people who are Democrats who are very nervous about the likelihood of winning, meaning they think they're going to lose. Well, the question is what happens to the Democrat Party then? I'm not going to get involved in all this, but I know there's great divisions in that party, and it could fracture the party maybe permanently, such that maybe the radical left within the party takes it over and that becomes the dominant. I don't know. But it's going to be disturbing, and I'm going to bet there's no way out of this that's going to be quiet and calm. And that is not factored into the markets. You do not hear it discussed on the financial channels about what does it mean for, stability, et cetera, et cetera. But I do see it in the technicals of the S&P and the NASDAQ where they're extremely tightly dancing above minefields on momentum, not on price. Price looks super. But then again, if you go back and look at the 1929 top or look at the 87 top, which is happened to be a break I caught, didn't catch it. I didn't make millions of dollars. I caught it in a nice way, though, with puts. It was like 2 weeks. It was like the end of the world. And when you looked at the price chart, you could not see any pending vulnerability. It's only when you looked at the quarterly momentum, you could see floor that had been used and used and used, and therefore was vulnerable for breakage, not evident on the price chart. And when it broke, it was like people said, what's happening? Totally shocked. And I think we're in that same situation right now where we have structures below in the stock market, especially the U.S. market. To some extent, it's reflected by the Sensex in India and the Nikkei in Japan. But mainly the U.S. market is the biggest stock market bubble on the planet right now, technically speaking. And when it breaks, I think there's going to be a shock effect. And right now, nobody thinks it's going to break. So that'll make it even more shocking.
Now, as for bank stocks, I know you recently put out a report showing how a lot of the same issues are with the bank stocks. How do you see this election possibly impacting the banking sector? If there's no, copacetic outcome, then how do banks react?
No, there's a lot of cheering right now because the banks have gotten strong of late. In fact, there's been some days recently where the S&P will be down, the banks will be up. And they've got some good earnings and so forth and so on. But when I look at the technicals of too many of the large banks like Citicorp, Capital One, or Wells Fargo, and we ran a few others, we picked them almost at random. And when I ran some of their momentum studies, they showed that while the price charts look like they're chest beating happy, okay, and everybody's been cheering them lately, the momentum chart suggests not so. It's not so good looking. In other words, if they sneeze a couple %, they could begin to break some things that would shock people. And where suddenly what looks so good on banks 2 months from now might look very bad and very quickly. And I'm talking about the momentum structural technicals underneath the market that most people don't look at or don't know how to look at. And they don't look like what you see on the price charts. And that's almost always the way it is near a top in something, is the price looks just absolutely cheery. And you don't see any particular technical vulnerabilities. But momentum warns you, it's not what you think. And that's where I think we're sitting right now. And it's therefore the shock effect that's among the happiness now. And everybody thinks soft landing is a given. Okay. We shall see.
When it comes to precious metals, then, if we kind of see a disruption in the stock market, possibly in the banks, how do you see that all impacting the precious metal sector?
Well, I think, if you go back to, I think it was March of 2023, we actually had a bank crash, meaning there was a period there where the S&P had already made its low in 2022 and was firming up. And in March of 2023, the banks, and MSA called this, by the way, we could see there was vulnerability on momentum structures of the KBE, which is the bank ETF. And this was in late January. Well, in early March, you triggered those technicals, and you actually had a 30 to 35% drop in banks in a matter of a month. That's of crash dimensions. The overall market suffered a little bit. The banks suffered a lot, very dramatically. And of course, that woke people up. There were the stories about the mid-tier banks and so forth and so on. During that time, gold went up. So in answer to the question, as an example, the banks actually had a crash and gold shot up strongly during that same period. I see the overall market going down, benefiting gold. This has historically been the case in other prior major bear markets in the last 20 years. 2000, 2002, gold went up, stocks went down, and gold kept going. 2007 to 2009 and on through 2011, gold went up. Well, the stock market went down to 2009 and took it several years to even get back to its high. Meanwhile, gold, took off. So I see the stock market break is fueling the gold market, and especially the miners, as portfolio managers move money into that which is working. Whether they like it or not, whether they understand the reason for doing it, they're looking around at sectors that are doing well. And if the miners are doing well and the miners are cheap, and so-and-so bought them 6 months ago and he's doing quite well, maybe I need to join in. And it's a very small sector, miners, gold miners, and silver miners. So, if money flows in, it's a wet bar of soap being grabbed. And the other factor is there when the stock market breaks, historically, that's when the data points shift. So today we got some good data points, right? Okay. You usually don't get an ongoing negative pattern in the data points until the stock market tops. You don't get them ahead of the stock market break. You get them afterwards. And what would that do to the central banks? We know what it would do. Pedal to the floor. Monetary policy would ease, money supply would grow, rates would drop. And that helps fuel gold.
Maybe counter, if you could answer this to your premise that, the election being, causing a lot of social unrest will be kind of a catalyst for this. It doesn't seem like to me that this kind of social unrest has a long-term effect on markets. Maybe you can share your insights on this, but is it kind of that we're already seeing a bubble in the stock market and this will just kind of pop that bubble?
It's a factor that could help pop the bubble because it's an ambush, meaning people aren't really, they expect it if Trump loses, okay, one side does. But, I'm arguing that it doesn't matter. You're still going to have an upset. Now, I'm not defining what it's going to look like. I'm not advocating or anything. I'm just sitting and observing it. And the University of Virginia Department of Politics poll validates that. That was a year ago. We know that those tensions and hatreds have risen since then. So whatever data points they came up with then are even worse now, you can bet. In fact, they may have updated it. I don't know. And they're looking at it objectively and scientifically. They're not opinionating. And so it's just not in the market. And we don't normally have that kind of outcome. fact, I can't think of one in my lifetime where you've had that kind of outcome. You have it in third world countries, maybe sometimes in Europe to some extent, but it just doesn't happen here. Well, if it happens here and you're a foreign investor in the U.S. markets and you suddenly say, gee, this looks like Venezuela or something, or you get my point. It creates uncertainty and therefore fear. And fear creates change and emotion. And people want to protect themselves. And portfolio managers want to protect themselves. So they will quickly hurry to whatever is working. And I'm arguing technically that already gold we know is working on the upside. It's not exploded yet. It's still going up in an arm wrestling manner. So there's not a lot of emotion in it yet. That certainly in the United States or the Western world. It's mainly, buying from the other part of the world. But if all of a sudden we get rattled here because our stock markets start to break, then emotion gets injected. Now we know people are already hurting on the consumption level, the cost of goods and services. The credit card, with delinquencies are rising and they're pinched. What happens if all of a sudden everybody's retirement account drops 20% quickly, in a month or two or three, or 30%? All of a sudden the pain becomes excruciating. And therefore emotion comes to the fore. And when you get emotion, you get changes in behavior patterns and money moves. Okay. So I think these things are all out there and they're right on the cusp. And I think that the pin that punches a hole in it is that stock market. And that's why we're watching it very closely.
Well, it will be interesting to continue to track this with you, Michael. Probably the next time we have you on, it'll be after the elections. So we'll see this all in real time. If our viewers are interested in finding more, they can go to olivermsa.com. Can you tell us a bit about that?
Yeah, go to the site and explore around for a while because we explain our methodology, which is unorthodox. It's not normal technical methodology. We've been around for 32 years. Our original clients for the first 10 or 15 years were only institutional. And then we opened up to retail subscribers. But we don't just look narrowly at this market or that market. We look at all the major categories. And especially in this day and age, these things are impacting each other. So it's important, if you're in gold, to be paying attention to the stock market, paying attention to the bond market, because they're speaking to you in different ways. Anyway, thanks, Elijah.
Thank you so much, Michael. You have a great day and God bless.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 14th through October 21st, 2024, while supplies last. First, we have pre-33 $10 Liberty Gold Eagles in XF condition, just $24.99 over half of spot per coin. Next, backdated 1-ounce silver Australian Kangaroos are just $2.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.